So thank you for coming. Today's topic is about market and its life cycle. So this is a very important topic. If you're trying to understand or if you're trying to be successful in trading, there are certain components to your success. So this is the second component, the market. Above market is the most important component is you. So you're the number one ingredient in your success. And then number two is the market. And then comes other components like trading systems, then your trading strategies, and then your trading symbols. So I have another uh, class on that. Um, I calling it developing your profitable trading system. So trading systems, trading strategies, and trading symbols. So SSS, systems, strategies, and symbols. So when you combine those three, along with understanding of the market and understanding who you are. So there are five. And then the sixth component is the risk management. So understanding who you are, understanding the market, then understanding the risk management, three, then understanding the trading systems you have or not, then understanding the trading strategies, what trading strategies you deploy when you're trading, because different person, different strategy, different market, different strategy. So and then what market, what symbols you're trading, because there are maybe 20,000 symbols. So if you're trying to trade 20,000 symbols, you will fail 100% because you have not traded before. So you want to trade something which you are trading, you understand. So it's like going to a new territory. When we are traveling and we go somewhere and then we get lost, we need to take help from GPS and the volume is on and attention and the music is off and everything. Whereas if you're going from home to work every day, you don't need GPS, so you understand where you're going, and unconsciously you're just taking right turn, left turn. So that's the way the market, you want to be like that, laser focus. Within a few seconds you understand what that symbol is doing. So traders just go run 20,000 symbols on their platform, or they just run the scanner. So it's not good. It's all will lead to disaster. Never be successful. I guarantee if you go 20,000 symbols and don't know what is what. So understand six components, which is you, number one, and behind you is too many components behind. So everything has a subcomponent. Then comes the market, two. Number three, risk management. Number four, trading system. Number five, trading strategies. Number six, the symbols. So when we combine all these six, and then further, you divide it further. Um, um, Whether your trading horizon is, so strategies depend on your trading horizon, whether you are a short-term trader, long-term trader, scalper, etc. Then you need to have a different account. So traders do trade everything in one account. That's another recipe for disaster, uh, because you get carried away. You carried away from option to stock to futures to forex. Everything is mumbo jumbo in one stock. So you don't have any way of tracking and controlling yourself. Because if you open an account, just let's say $100,000 account, and you say, okay, I'll trade. So then now you're trading stocks. You're also trading options. So logically, you said, okay, 75,000 will be towards the stock, and I am sharing my screen, but I have not changed it yet. So I'm still talking on my title screen. So these are the off topic. There's no slide. I'm talking from another presentation. So what I'm saying is that if you open an account for $100,000 and you logically, you mentally, you're saying, okay, I will restrict myself 75,000 towards a stock and $25,000 towards option. You will not be restricting yourself. You will go over. When you find the trade, you go just go over from option to a stock portion. And then by the time you realize you're 100% trading options, you're not trading stocks. And the style of trading you wanted or the type of trading you wanted was speculative. Now you are in that boundary of conservative trading, which could be the stock trading. So, there's so many things to to understand in the market. So in trading success. So we talk about you. It's a big topic. It's another presentation or another. It's I have another course, 8-day course. So if you're interested, send email to my team, success@tradegenie.com. If you're interested in going into detail, there's an 8-day course. Anyway, so this is from Shakespeare, Seven Ages of Man. So when I was um, um, growing up back home in Pakistan, and I recently migrated from India. So I migrated from a young age, from a village to a bigger city. And my cousins who were going to the private school, etc., they were learning Shakespeare. So I came across Shakespeare. First of all, I had no idea who Shakespeare, and they were talking about it. So curiosity, I started looking for the volumes or the for the some play of Shakespeare, and I bought all the big volume from second hand from someone. So the play, as you like it, this is the whatever you call. I'm not remembering the the exact sentence, the word you use. But here is here is from Shakespeare, and I will relate it to you in trading. How it this is relates to trading. So he is describing 7 ages of man. So there are 7 stages of man, and just like 7 stages of man, there are 7 stages of market. So I'll try to explain to you what are the 7 stages of market, and then you have to understand what stage the market is in, and what kind of and then individual symbols. So not only the market is going through its stages, its life cycle, and then individual stocks in that market is going through those 7 stages. So think about it. So the whole market is going through that 7 stage, and then each symbol. So here is the chart, and I color depicted to explain to you clearly what are the 7 stages. So if you don't understand, or if you don't understand the big picture of the market, we will fail. So there are so many things where odds are against us if we don't understand. But if we understand, uh, too much money coming in. So think about it. If everything, if you understand everything, and then system, then lot of a lot of wealth in the market. So here's a big picture and time frames. So the time frame. So this chart I'm showing you, this is applicable. So you can put it on your time frame. So whatever is your time frame. So the market, there's something called fractal. So the market uh, work the same chart or same stages market go through in all time frame, whether it's a 5 minute time frame or is a monthly or yearly time frame. If you put the chart, if if you study it, you can see that in a yearly time frame if you're looking for long term, or you can go as low as 5 minute or 3 minute. Is it does the same thing. So that's what I'm trying to say. It does the same thing. And if you are trying to learn something new, let's say I'm trying to learn some chart pattern, or you're trying to learn some chart pattern or indicator, try to learn it the lower time frame, because it's the faster. So if you put something, if you're trying to understand in something in a long-term time frame, which let's say weekly or daily, you will see only one time. But if you're trying to understand something very quick, um, put it in a lower time frame so you can see the result quick. That's why if you're trading, if you're new in trading, maybe do small trades and bunch of trades instead of just one or two. Put too much money in one or two and then just sit. There's no opportunity to learn. Why not put 20 trades, small trades, and then you learn, because learning from mistakes. So here's the 7 stages of a market, and the time frame could be daily time frame, it could be weekly time frame, or it could be as you can put it on a 30-minute time frame. So I will dissect and I will show you especially how you can take advantage of this phase 4, which is going on right now. And this, so market is in phase, let's say in phase 4, stage 4 right now. So when the market is crashing, let's say last 2 months or 3 months, when the market was a downtrending, so just call it downtrending. I call it downtrending and uptrending or sideways. I don't look at from the bull, from the bear. So that's too much. So that's too much for me. So I look at downtrending because the market could be in a bull market, but it's downtrending. So, so they can say the market is bull market, but if you look at the chart, it's downtrending because the longer the signal takes, the longer the time the signal takes to give you from bull to bear, the what is it? The damage is done. So if the market makes a low 20% pullback, so imagine 20% pullback. By then, it's just overall market 20% pullback, but the position you have maybe they're down 80%. And if you have options, then they are completely wiped out. So bull and bear definition is too long. So why not divide it into uptrending and downtrending, and then in between the sideway? So that's what I do: uptrending, downtrending, and sideway. Now I will show you my. I've created an Excel worksheet, like easy to understand what my software does, and tell me at any given a day um, what the market condition is. So I made it easy for me, but it took me like 15 years to understand. So must have. So imagine this downtrending market. So market is in downtrend. So when the market is downtrending, so I depicted in one. I don't know what happened before. So just to start somewhere, I'm showing you stage one. There could be something before. So let's say the market was uptrending or sideways, and then the market started to crash. So just look at this one here, and before one was six, five and six. So just think of it that before one was five and six here, stage five and six. So when the market is moving down in downward, first of all, the downtrending market is a volatile market. So it goes up and it goes down. So it's hard to make money in a downtrending market. It's hard to make money in a downtrending market because it becomes a volatile market. One day it goes up and another day it goes down. So it becomes volatile. So the overall the market is going down, but the positions are going up and going down. One day they're up, another one day up. So you lose money. So when you recognize, you need to cut down your exposure. And the downtrending market, sometimes the downtrending market just suddenly moves up because there's some incentive, some catalyst comes, and the market just reverses, and all your downtrending positions, the short positions or the put position, they get damaged. So the way the downtrending works is the short-lived. First of all, is short-lived. It's volatile. It's short-lived. It's the bears and bulls. They both lose money in a downtrending market. The bears also losing money, and the bulls are also losing money. Both of them are losing money. Now, at the end of a downtrend, let's say any stock or any market, the volume builds up. So the volume went up, it increases. So their final people are giving up. People are giving up. They're getting their margin calls, or they have some other obligations. So they have some other obligation. Maybe they borrowed money, their payments are due, and whatnot. So there could be 10,000 reasons. Because when the what is it? Bad situation comes, it doesn't just come from one side. It just come from all, it come from everywhere. So if you're not prepared, if you overborrowed from one side, or you lose the job at the same time and the market is crashing or something is happening, the bad economy or COVID, etc. So not only you losing money in your stock market, you lost your job, your business is closed, the partnership you did, the partner ran away with the money. You lend money, you borrowed money, your contractor ran away, he's a cheater. So all that, so more cheater comes out. So all that happen, and then you lose money. So when that situation is appearing, the volume is increasing because everybody is looking to exit. So what do? We fail to recognize the volume climax or the oversold position, and then we lose. So keep that in mind. We lose because we are trying to Either we are closing the short, all the long position right at the bottom, or we are trying to open a short position right at the bottom. So when the market reaches the bottom of stage one, then it doesn't want to go down. So it creates a stage two. So the how you can recognize the stage two, the market goes down one day and then it goes up, and then goes down one day and then goes up, and the volume dries up. So there's no volume, very there's no participation. So all the bad things um, just came and gone, and no more bad news. So there's somebody there who is interested in buying, so they buy a little bit of activity, and the way that if you count the number of days, the up days and down days, if you literally count the candles, you will find more down days and then less up days. But the down days are not as significant and the up days are not significant. So the net result is like almost neutral. So it becomes like a neutral, even though down days are more than up days, the position is neutral. If you look at 10 days of move, it's nothing. There's nothing there. So there's no move. So if you have a deep pocket, if you if you say, okay, I'm going to buy some shares, so you can buy it, but you don't know what will happen, because the stage two here, you see the stage two, I put it in the orange, and then there is a stage three. So there is a stage two and a stage three. This is stage two and three. It looks like a V-shaped recovery. It can turn into seven, stage seven. So just after one, there could be another scenario like a stage seven. So, so how do you know? So how do you know when the market is in a stage two, whether the market will do is like a stage two and then three and then four, or the market will do convert into seven? So you don't know. Nobody knows that. So for us, unless we have a lot of resources and a knowledge and a deep pocket, and we are big boys and trillions of dollars, we need to stay away from this kind of a market. It's just useless. But, if you buy options, so if you buy shares, even if you buy shares, there's no time decay, but there's a lost opportunity, the opportunity cost. You rather put your money on another horse, which is moving faster. So and by the time, so another disadvantage, if you go long, so let's say on something which is in a stage two, you're missing out all those stocks or all those positions which are moving up. And by the time the your market or your symbol, which is in a stage two and is downtrending but not as severe as is in stage one, by the time it wakes up, the market has reached its own climax. So now you said, okay, I waited for 1 month and I held on to this position, and now it started to move, but then it will stop moving because the overall market has reached its peak. So now your that position which you were holding for 1 month, uh, even though it woke up, but it just dies down because the overall market is down. So try to avoid anything which is in stage two, where it's a tiny candles, 1 day up, 1 day down, 1 day up, 1 day down, there's no volume. Now, after two, the market can turn into stage three. So this is where the accumulation is going on. So when the accumulation is going on, you will see more up days than down days. There will not be sometimes suddenly there is one bar. You will see sudden move, and then one big white bar appears, and then market goes down 3, 4, 5 days. It's just down, and the red days, white days, red days, white days, the volume is low. But then out of all these red days, white days, there is one bar which is kind of big bar, white bar. Sudden reaction happened, and then somebody recognized it and they bought it, and it's done. Or maybe there's small bars or candles with some volume, but more net up days than down days. So now the market is doing this. So the what kind of a strategy you can do? Maybe you can create a vertical spread. So you go long, so you can create you can go long on a strike So the way you can, so there are various kinds of, so now I'm talking about a strategy. So the vertical spreads, they could be aggressive spread or a medium aggressive or conservative. So it depends what you are expecting in the market. So you're creating vertical call spread. Now, since the market is in stage three, so I'll create another presentation and explain to you about the vertical spread and the different strategies which you can deploy based on the stage of the market. So when the market is in stage three, maybe you can buy shares if you have a bigger account, 2 million, 3 million, I mean, 500,000, you can buy some shares, 100, 200 to initiate a position. And I mean, you initiate a position and your skin, you know, the skin in the game. So when you have a skin in the game, and you're emotionally attached, you tend to watch that position more like regularly. It's right there in front of you because you are invested emotionally and financially. So you can create a vertical spread also. So one of the trading strategy. So one person is buying shares, another person is buying, creating a vertical spread. The kind of vertical spread you can create is look at the lowest low. So look at the lowest low, and then you say okay, and then match it around the strike. So look at the lowest low somewhere and match it with the strike. So the if let's say the lowest low was 96 or 97, so the first strike we will buy is the long calls 95. So when you buy 95 and the lowest low was 96, so you're kind of buying in the money. So you're 95, you're saying okay, I buy 95 and the lowest low was 96, or 96, 97 was the strongest support. So based on the support, you're buying in the money based on the support. Now the short strike. So now the short strike. So if you buy long strike, let's say 95. Now the short strike, which you're selling and collecting the premium, so you're creating the vertical spread. It depends on. Um, so that's where the skill or another skill comes. It depends on where do you see it will go in that time duration. So if you're buying a 60 days out in the future, so in 60 days, where you expect the market to be. So if you expect 115, then you may want to buy 110 or 115. You want to sell 115 and or 110 strike. So when the market reaches that strike, that short strike is at the money, and your long strike 95 gains more than the 110 or 115 strike will gain. So that's where you will get the maximum gain. So depending on the stage three, you're creating a vertical spread, or you're going buying shares, or if you're buying is simply buying calls because you don't know how long it will take for the stock to accelerate. You need to buy in the money, to strike in the money, so you don't incur the time decay. So people ask, how do you select the strike? So the strike and the time duration depends on how fast you expect the stock to move, where it is in terms of which strike you're choosing, what's the condition of the overall market. When the condition of the overall market is bullish, like doing in stage four, you can buy out of the money call because everything is moving, and then you buy out of the money call, it goes in the money. But if the market is like choppy and is in a stage three, you will buy in the money, maybe two strike in the money. So I do all that. So you would see me sending you the trade alert. Sometime I send you the alert in a deep in the money, one or two strike, and then when the stock is moving, I send you another strike, another strike. So buying another rolling the strikes because expecting the market will reach to stage four. So now I need to explain to you what is the stage four. So stage three was the accumulation. Stage four is where some catalyst comes. So like market wakes up. So I'll give you the date based on the analysis I do. I'll give you the date. So the date is, so let's say the date is 30th of October. So where the market was in this condition, 30th of October. On 1st of November, the market woke up on 1st of November. So I'll show you. I got the signal on 1st of November. First, I got the signal on 30th of October as a warning, and then 1st of November, I got another signal for the market is in establishing its uptrend. And then on 14th of November was the final confirmation. So 30th of October, then 1st of November, and then between 1st of November and 14th November, final confirmation, the market is in uptrend and it is still in uptrend. And in between, there are other things. So this is the stage four. Stage four is a long stage. It's a bullish stage where a lot of buying going on. Overall market is participating. All if you look at the individual symbols, so this is just individual symbols. So look at think of, let's say, whatever, AMD, Nvidia, or Apple. So, or any tech stock, just look at the stock. So this is the stage four. So it just gap up. So the new catalyst comes. So most likely there was a consolidation breakout. So if you understand the consolidation breakout, you will catch it. Or if the market gaps up here, you will be able to catch it. If another candlestick patterns come here, you will be able to catch it. Maybe the trend line is established, you will be able to catch it. Maybe there was a volume spike and you're reading the volume correctly, you will catch it. Maybe you have some magical indicators, you will be able to catch. So this is where the most of the money is made, in stage four. This is the market where the short-term traders, or as long as the fortune is made. So the fortune is made in stage four. All other stages, you go fishing. Just cut down your investment, unless you are a long-term trader and then you just buy forever. So you will be very happy if you're a long-term trader. So I don't understand this. If you're a long-term trader and you see this stage one, you should get very excited. You should get excited. There's a more opportunity for me to buy more cheap instead of getting depressed. Uh, uh, if you're a long-term trader and you have the strategy to keep on adding to the position. So like your 401k, your IRA or something. So you should be getting excited. Would you be excited if you buy Apple at 200, or you getting excited? Let's say you have Apple position and now it's 199. It's like Apple, I think it's again topping out. I mentioned back in when it was breaking from that 193.94, send the alert that Apple is topping out, and it topped out at 198. Then it dropped to 168, 165 somewhere, and now it's back to 199. If you look at the daily chart of Apple, it's telling you that it's topping out. It's a clear sign for me that Apple is topped out again at 199 plus something. So keep an eye on Apple. So would you buy Apple at 199 or 200, or you would be happy to see Apple go to 165 or 150 if you already have a long-term position in Apple? Which one you will prefer? If you think Apple is a $4 trillion stock, a $5 trillion, and it's right now it's 3 trillion, then you should say, I wish it goes to 2 trillion market. Then I will buy more or on the way down. So depending on your trading horizon, if you're a long term, you should be happy your positions are going down, so you can average. If you have a trading strategy of adding every month or every 2 weeks, and if you don't, you just a constant, you just invested it and then nothing, you're not adding anymore, then your strategy is prayers. Then then you have a prayer strategy that it goes to, I hope it goes to 4 trillion so I can sell. But then if it goes to 4 trillion, why not it goes to 5 trillion? It should go to 5 trillion. So think about it. So who you are and what you're trying to accomplish. So maybe the Apple is crashing, and then you can start doing something. Start selling calls, collect the premium, whatever is your strategy. So stage four for short term or position trading is the best stage to make the money. And I will show you the volatility also. So I divide the volatility into different categories. So right now the category of the volatility is very conducive for investment. But in the short run, the market is topping out. So I will explain to you. So stage four now. So stage four is where the catalyst comes. So we need to divide. We should be able to divide or dissect the stage four, which is the most profitable stage four. This is where you ask yourself what kind of a trading strategy I should adopt or trading system I should use. So based on the so not on so the market type. So the market type. So if I'll explain to you in different slide the different market types. So the market type, if the market type is uptrending, and then the market type is not only uptrending but quiet. So uptrending and quiet. So when the market type is uptrending and quiet, you will implement the trending strategy where the market is in a trending mode. And so then you say, okay, how do I find everything is trending, is just moving parabolic? So patience. Out of all those stocks you have, look for that one which is giving you clear-cut re-entry signal. It has given you entry signal right here. If you look at the entry signal, it's right here. So the entry signal for most of the tech stocks was right here, and they are all trading at here. So if they're trading here at the top and the entry signal was here, how do you need to, if you're short term, that's where the traders lose money, because the entry signal came here on 1st of November. Most of the tech stock, the entry came on 1st of November or 2nd of November, something like that. Somebody woke up at 2nd November, somebody 1st November, some 31st of October, somewhere in that vicinity. If you go back, look at the tech stock, they gave you the signal here. Now today is what the market was December 17th, so December 15th. So December 15th, they are sitting here. So if if they are sitting here, how do you decide to get in? What if you may be catching the top? So have some rules of your re-entry. So think about it that you are trading as if you're re-entering it. You had a position, you exited, now you're looking for re-entry signals. So do you have a system where you can say, okay, I already have position in it, let's say, and I want to re-enter. I want to scale in. So do you have a strategy for that? Or I don't have a position, but I want to get in, so I'm looking for that point of entry. So in a trending market, for the point of entry is purely based on the pullback. So now you say, okay, the pullback. So how do you recognize? So do you have a system where you can say that this is a pullback and not a correction, or this is a meaningful pullback and I have a proper entry? So I will dissect, I will show you just a second before I explain. So the top of stage four, then comes the stage five, which is the last um, run up in that market. Possible. So possible run up is categorized as stage five. So stage five is where the market is overbought. So every market reaches the overbought level. So this is the overbought level five. And number two, depicted here in orange, you consider it as oversold level. So market deep oversold. So oversold level doesn't mean that market needs to go up. It can remain oversold for many months, years. It can remain oversold. And overbought, overbought doesn't mean the market will pull back. Overbought means that a lot of buyers are already in, and now the market is waiting for the new catalyst. When the market reaches a new catalyst, it will break out. It will break out and create a stage four again. So from five, it can create a pullback. Maybe it does six. So six is where the distribution is happening. Do you read the news where it says Warren Buffett sold 50 million shares back? And then when you look at the date, it says the date is like 30 days ago. And then, so when you go back, when you say, okay, he sold 50 million shares on this date, let me go back and see. And then you say, damn, I cannot see anything. There was no sell signal. There was no, it was just quiet. Market was doing it. Of course, if he orders his minions to go, or any other big boys who are smart enough, they give the order that sell 50 million shares, but every day they are selling like 1 million or 2 million quietly. They're not dumping 50 million in one shot. They just quietly, they get bonus. for the best price. So they are given the target to execute all the trades at this best possible price, this price. So the traders' job is to I mean, if you're given the task of, let's say, 2 million shares every day, so will you go and dump 2 million shares, or you will go quietly and sell 100, 100, 100, 200, 100, 100, and then buy? I mean, if you keep pushing a button or run a program that 100, shares, 100, 200, 300, and you fool everybody, and then you are out and sold net 2 million shares quietly, and you didn't move the market. So this is the way the distribution works. Nobody notices it, what's going on. So stage 5 and then stage 6. In stage 6, the net days kind of negative, on the negative side. So you will feel it. If you're watching it, you will see the market spikes, and then the net result down. So last 2 3 days, that's what Apple is doing. So I'm just warning you um, that Apple spikes, and then it. So I had calls that just got out at 199. I don't bother if Apple goes to 199.60 uh, or 199.80. Sell Apple at 199. So, so the distribution may be happening in Apple. I'm just telling you. So the distribution net days up. So market create a spike move and then pull back. Now, so there's no buyer left. There's sellers are there, smart sellers. Now, some kind of a negative news come. Suddenly there's a negative news. So so everybody is exiting. So people buy for many reasons. There are various buy orders triggers. There are various buy orders. Buy orders triggers based on your buy signals is triggering based on 30-day new high, 2-month new high, or some this moving average goes above this moving average. Okay, buy it. Or this news come buy. Or somebody sitting in the Fiji island, he's buying it, and by the time I am sitting in San Diego and I realize, okay, I buy it. So there are thousands of triggers happening, and that's why the market keeps moving up, because 2-month triggers, 3-month triggers, 50-day moving average crossover, 20-day moving average crossover, so many. But there's only one reason: panic. Some bad news that everybody is getting out. So there's just only one door. So like in old days, I was reading it when our forefathers came from different countries to New York. So when they landed, they were all taken. So there was a kind of problem, marriage problem or whatever. So they all the men and women, when they come, they were taken to a church. So there were like 4 doors or 5 doors, whatever doors were. So all of them enter from different doors, and then they made one big door, and there was a pastor there, a priest. And so when they go inside, they were supposed to find, they cannot leave that church or that building till they find somebody to marry. So the condition was find someone and then come and get married and then get out. So there was one exit. So there were 4 or 5 doors to come in, one door to exit with your spouse. So that's what happened. There are many doors to enter. There's only one door. And so when after stage 6, the stage 1 is happening. What is happening is uh, people is still believing in the rally. They're believing in them that they're missing out. So they miss out here all the way. They saw the move up from 4. Let's say from stage 4 to jump up to 5. So now they are getting a deal here. Back to this is price point 5, where the stage 5 begins. So when the market comes here, they're getting the deal. They think there's a deal, and sometimes it's a deal because the market pulls back and then create another stage 4. So it comes true. But a lot of time this deal turns into stage 1. So they cannot believe it. This is happening to them again. Why it's happened again and again? Because they wake up late. They're too late. So 3 4 days ago, I had a physical checkup, and the doctor's nurse, she just asked me, oh, I forgot to ask you, what do you do? So I trade stock. Oh, which stock is good right now to buy? I said all of them are bad. And so she looked at me. Why are you saying all of them are bad? How I can tell which one is good? because everything is running up. So I told her buy awesome oil stock, and then she said, "No, oil stocks are very expensive for my taste. So I don't know, maybe buy some a small cap." But if you look at the small cap, they are all run up 50%, 100%. So which one? I have no idea which one to buy. Maybe you're entering in a stage one. Who knows what's happened? And I'm not there to monitor and guide you. So this is useless. So stage one, panic and depression occurs. It's just repeat. Now, the after stage one, it could be stage. So you will adopt a different strategy here. When you're not adopting the trading, you're not using the trading system here. The trading system you use here for stage four is different than for stage one stock. So it's on the short side. It's a short term, and it's you're looking for a quick move. So so now after stage one, it could be stage seven. Stage seven looks like this, a long bottom forever. But it may not occur like a V-shaped rally, stage two and stage three. So so not knowing where the market is, who we are, where the individual market. So if you look at QQQ, it looks like in right now in stage five. Yeah, I'm not saying that it will do this. I'm just saying it's overbought. So if you look at the QQQ chart, if you look at Apple and other stocks, so the way you will see that if you are monitoring the big the Nasdaq stocks, they will show negative days more than the positive days, and the negative days will be bigger in size than the green days. So keep an eye on that. And the QQQ is looks like, so I had calls on QQQ, and I also so I QQQ calls, another thing, QQQ calls and Apple. So it's like you're going to a summit. So I was trying to explain to my friend John, if you're going to a summit and you are going from this side, right side, and I'm going on the left side. So both of us are going to the summit, and then we converge. So we reach the top, and eventually we reach the summit at the same time. Now what? So we reach the summit at the same time. Now the only destination is to come down. So when we are coming down, we meet other fellow climbers, and then we say, okay, time to go down. And then they say, no, 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 we still have to go to the summit. We are just half an hour. And then you say, no, 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 the time is running out, let's go down. And they don't listen. So they eventually try to reach up, but then they give up because their other stocks are giving back up. So there are some stocks which are leaders, which tells you some sign that it's topping out. I'm not, again, just keep an eye on QQQ chart. And another one, so people pay attention to price most of the time. Most of the traders, they are paying attention to the price. So they are not looking at the volume. So that's a big mistake. They're not paying attention to the volume. So if you pay attention to the volume, then they say, okay, pay attention to the price and then pay attention to the volume. So that's what I also say, 50-50. So 50%, if you only pay attention to the price, and if you ignore the volume, then you're missing out the 50% of the equation. So you must pay attention to the volume, and you must pay to the attention to the price. But the third component is the time. So time, you need to pay attention to the time. So how in this situation, how we relate. So this is my past, based on past experience. Something big event occurs just before or after the market temporarily or long term or something tops out. Event occurs. So imagine this: the market, if I'm right, I would give you show you my signals. So if I'm right, let's say on 1st of November, market gave an early actually market gave early warning signal on 31st of October or 30th of October, and then it gave signal. So market gives signal in stages. It just doesn't bam, it doesn't do that. It shows slow. You have to detect the change in the trend coming. So on 1st of November, the change came. So imagine if the big boys were bought all these big stocks on 1st of November, and December 15 or 13 was FOMC. So for 45 days, they enjoyed the run. Do you think they're waiting for Fed to say that we will not increase the rate or doing something which is positive? Maybe they were just waiting and got the green signal, but I believe that most of them already in. So they will they will cash in rather than add. So who will be adding it? The those funds who lose money, or they are on the, they're on the loser side, or the retail boys. So those stocks will be, so the let's say the technology stocks are moving, the technology stock will be sold, and the money will be rotated to another sector. So what sector? Those stocks which were not moving. So think about that. So FOMC, let's say, occurred on December 13, 45 days after the initial signal in the market. So just before or after, if you analyze all these major bottom, major top, they occur a lot of time, they occur around FOMC. Uh, so based on FOMC occurred on December 13. You have to be, instead of saying, okay, it's time to go long, it's time to be careful in going long. Pay attention. So that's what I'm saying. So time, pay attention, what the market will do. So market may go to the moon, who knows. So anyway, so this is about the market. Now, if you dissect stage four or any stage, so you must have a way of dissecting it and trading any for your entry. So look at this. If you divide the stage four, so this is uptrending market. So what is the definition of uptrending? That the higher high and higher lows. So that's the definition of uptrending market. So if you take, if there are two higher highs and two higher lows, you put the dots, connect the dot. That's higher high. And then if you want to really confirm, then you take three dots, three higher highs and three lows. But most of the time, traders are late, because by the time three higher highs and three higher lows are formed, the trend is already in motion. So you need to identify that, okay, this is uptrending market. Now I'm looking for some kind of pullback. So the pullback you can identify is identifying the support and resistance. So this is one of the best way to identify the support and resistance. So now we say, okay, what is support and what is resistance? So support and resistance, so think about it. Support is where the buyers are. That's where the demand is. The resistance is where the sellers are. That's where the supply is. So support and resistance are the name of demand and supply, the buyers and sellers. So demand and supply. So think about it. Anytime, like you look for the proper price point to buy, according to your you have, let's say you're planning to buy something. So you're looking for some kind of a pullback, just going and willy-nilly buying. So you come up with that. I want to know where the previously the buyers were in and the sellers, where they fought the battle. So that's what I'm trying to say. To identify the level of the region where the battle occurred between the buyers and sellers, and one party won. So who won that battle? So the support and resistance is a battleground. It's like a graveyard where a lot of buyers and sellers got buried, and eventually somebody came out as a winner. So who came out as a winner at what price point? That's the role of a trader, to identify that level. So I'll try to explain to you. So this is let's say this is the beginning of a stage four. So this is a stage, a beginning of stage four. So the market, when it is starting a sudden move in stage four, sometimes it just keep going, so it's fine. But a lot of time the stock, they just initial impulse or initial move, the market, that initial move, the market pulls back 50% of that initial move. So just 50%. So I'll explain to you here. So let's say this is, just look at imagine the price. So this is a 95. So think about it, that this is 95 and this is 100. So this is 100 where the breakout is happening. Now the breakout can occur in the form of gap, or just a continuous bar, a big white bar. So when initial move occurs, it occurs because there's some news there. So there is some news. Somebody is buying it. Somebody has some clue as to why. And then after they finish buying, it just they have the news, and others are still figuring it out. It just reached some top. So from 100, let's say it goes to 110. So it made its first initial move of 110, and then like it becomes like quiet. There is nothing going on, and then as suddenly slowly it starts to drift lower. So in that lower move, like 50% cut. So 50% cut is 5 points. So the market somewhere it goes to 105. So that 105 will become your entry. So you measure the distance. So you measure the distance and you say, okay, where will be the likely support? So um, so if you identify 105, this is a likely support. The mark, not only you're defining the price, but then is it you are you seeing what you expect to see? So are you seeing it what you expect to see? So if you expect to see that, okay, around 105 level, the market pullback will stop, and then I will watch for confirmation, some kind of a spike in volume or something is happening here, some form of a secondary evidence. It's like you have detectives here lined up, and you're telling the detective, hey detective, I gave you this price point of 105, now report back to me if you see something positive. And then these detectives come back to you and say, yes, I saw the spike, I'm seeing some buying pressure, I saw that candlestick, I saw this indicator lined up, I'm seeing this, I see some option activity, I think 105 is being valid. So you add more to the position if you have already, or you didn't have, so you will buy. So those who miss out here on the initial spike and saw the pullback, this is their opportunity. So they will get in. So there's buyers will come in at this level. The buyers were here, the buyers will come in here. So now imagine the buyers are here. So on the way up, because there were some buyers at this price point, um, that's the transaction happened, the buyers and sellers. So those buyers, they could be a weak buyers. So they could be the buyers who turn into a seller. So think about it, the buyers who are price point, now they turn into seller. So they could be a weak seller, meaning, or the weak buyers, they will just exit. They will just say, okay, I'm fine. Um, I'm lucky I got out. So instead of buying, so they have a different uh, dif instead of buying more, they are selling at break even or something. So they have a different mindset. So instead of adding more, they are getting out. So you will see some hesitancy, and then the market just keeps on moving. So what you can do most of the time, you can multiply. So this move occurred from here to here. You can measure it from here to here. It will occur again the same distance. Most of the time it will occur the same distance. So if this was a 10 move or 12-point move, from when the market breaks from this level, again another 10 12 points move is going to happen. So now the market reaches some kind of a resistance level. So this resistance level, now this could be a overbought level, and there could be a previous turning point. So pay attention to the left side. If you pay attention to the left side on your intraday chart or whatever chart, day chart, weekly chart, you may see some battle or some turning point. Something happened there, some kind of a range of up and down move, you some kind of a congestion. Something will tell you that this was the previous point where the market had turned around previously. So if the market had previously turned around, it's just doing the same thing. So your strategy, if you're a short-term or position trader, your strategy would be to exit at this level. So that's what I define it as a red target. So somewhere, if this is my green target, I call green, yellow, and red. So if this is the entry point, this becomes a green target, and somewhere here is a yellow, and if this is a major resistance, then I call it a red target. So I read all that and then communicate with you the green target, the yellow target somewhere here, and the red target, or this could be a yellow target. Now, if this so for some reason the market pulls back. So when the market is pulling back, we need to know how far it can pull back. So how far can pull back? There's something called polarity principle. So you need to apply the polarity. Is I explain in a different classes. So polarity principle means that whatever was the resistance before, now it has turned into support. So whatever was the resistance, now it is support. So then we say, okay, the market is pulling back. So now so when the market is pulling back, you're saying, oh, I need to find out where the support is. So in other words, what you're saying is, so the question to ask, I need to find out where was the previous resistance which was broken. So that's the question. So when on a pullback, you're saying, oh, I need to find out where the support is. So the question is actually the answer you're looking for. What was the previous resistance which was broken? And you're praying that I find the resistance level which was very tough resistance, and it was broken. So think about it. When a when a when a barrier is broken, um, with the force, that barrier become a strong support, because there were a lot of you're looking for the some support where the lot of action happened. There were a lot of buyers and sellers, a lot of transaction happened, multiple time, multiple attempt it took to break the resistance. So if market on price point one took multiple attempts for the market to break, um, the resistance, it becomes strong. So for instance, look, so think about this. This is the first attempt. Maybe there was another price point here and it failed. So this was the second attempt. So there was a price point. There was previously the market had battled here. So multiple time. So this is not one time. This may be the second time or third time. Or if this is the first time the market attempted and failed, now the market came here and it attempted and failed. So it can do like this, up, down, up, down, up, down, and finally it breaks it. So the multiple time it does its attempt, the more, and the volume is there also. So the number of attempts it takes and the number of volume. So when you combine the attempt and the volume, it becomes a strong support and resistance. So because the resistance is being broken, so it turned into support, because it took a lot of buyers to come in and take out the sellers. So think about it. There were a lot of buyers. It took a lot of buyers to come in with the force to take out all the sellers, because the sellers were adamant in not letting this stock or market go up. But finally, when the buyers were able to break absorb all the supply from the sellers, so there are tons of buyers at this price point one. So when the market is pulling back, they're already, it's like tons of soldiers waiting already there. They're already waiting there. So so when they're waiting there, they will come again. And knowing that other buyers, so other buyers who are called uncommitted buyers, they don't have any position yet, or it's a fresh money. They will join. They will join in the market action at this price point four. And there is another reason why they will buy at price point four. When you are drawing the support or resistance, you must ask this question: is there a support underneath the support? So it's like a basement. I call it basement. So if there's a first floor and then there is a basement, B1, B2, B3. So if you are in B1 and then suddenly the ground opens, and then you fall, then you say, okay, worst come worst, I will fall in B1. Oh no, I will not fall in B1. The worst, I will fall in B2 and I will break both legs, but I will not die. So, and then I will get my leg fixed and then I will come up. So think about this. There is a support. This was the resistance and this was the support. So this is the support and this is the reason. When you draw the line extended in future, market has not reached this level yet. Market is still here somewhere in the middle. So now you say, okay, I draw the line. This is the support, and then underneath is the support also. So this is the first floor and this is the B1. So if this price point two, the the gap between price point 2 and price point 1, if the gap is narrow, then the channel is narrow. If the gap between 1 and 2 is wide, then the gap will be wide here too, because you're just extending it. So it's 4 here, 2 here. So now when the market is coming down here, you know that the market have a very high chance to hold this range, this whole range between 4 and 5. So 4 and 2. So now the market takes off. So when the market is taking off, it will do the same thing. It will come to price point 3, it will do some hesitancy here, it will do some hesitancy, and then move up to 5. Now there's a lot of twist and turn. What if the market doesn't reach 3 and somewhere in the middle? Then what happened? What if the market crosses price point 3 and then doing something? So where is your sell signal? So that's another twist to this story. So there are various scenarios. So I'll explain sometime later. So now you reverse it. So that was a stage 4. So if you reverse it, this is the stage 1. So just same logic, you just reverse it. So this was the support on the way, a little bit pullback, meant to resist, created a resistance on the way down. Um, it will hesitate here, but then it's crashing. It's just crashing, and it reached some price point which we call support. Maybe there was a previous um, mm, turning point. Based on the previous, you see some turning point, or doesn't have to. Maybe there was some news. So the news came and the market moved up, but then the market so you see the market price point 4 and price point 1. So but if you are going long at price point 3 and the market is moving up, so not only the price is moving up, but then you have to pay attention to the angle of the move. So this is another topic. You have to pay attention to the angle of the move. Now, what is the angle? If angle is like this, it's a weak market. If angle is above, it's a strong market. So there are different degrees of the angle. So all that, so I teach you in 1 year coaching program in detail about how to measure all the angles and figure it out if it's a really a bull market, is a uptrending market, or is just a weak market. So for here, it's 1 and 4. So same price point, 4, and then it just hit the resistance. Now, what is happening here before it's reaching? But there could be many clues that you know that this 4 is will hold and the market will come down. So you have a different exit strategy compared to if the market is moving in a parabolic fashion. And not only that, you see here price point 4. If you extend price 2 here, is a resistance above the resistance. So not only so just like support below the support, resistance above the resistance. So when the resistance is above the resistance, it's a very strong resistance. If the support is below support, then it's a very strong support. So you don't want to wait uh, in this market to say, okay, let me see if it breaks the resistance. If it doesn't break, then I will get out, especially if you have options. So to be very disciplined and consistent, you say, okay, when the market reaches this resistance level, I'm out. I don't care, because what happened? The chances are that the market will waste its, even if it breaks the resistance, the market will waste its time, and every day you are giving back your profit from the option decay. So think about this. You can test it. The initial move, the price you get for your option, the sell price, after 5 days, when it breaks the resistance, it still be the same, but you risk. So you're risking, um, you're thinking that, okay, it will break, then I will get out and I will make more money. But if it does this, like five, and what if it takes time and then break, then it's still you're not making money. You're still making the break same. And further away you are from your price entry, the risk is increasing and the reward is going down. The extra reward. So think about it, the extra reward is like they say the law of a diminishing return. So they say, okay, When you make your 1 million, you get this. But then even if you make your second million, you still have the same. It doesn't matter. If you make your 100,000 and then even if you make 150, it doesn't make much difference. So it doesn't make difference if you sell here or 5 days later you sell here. You still get the same, but the chances are that you will lose. The chances are that you will give back and go back to five. So the further away you are from your entry, and you're reaching towards, your risk is increasing in terms of extra reward. So think about it. The reward is, so you need to recalculate your reward. The reward is, think about it. So you say, okay, reward. So what is my reward? The reward is from four to here somewhere. So because you can sell now, so you have the opportunity to sell here at 4. So just think of it, this is your entry price. The entry price is not here. Entry price was here, but it's not here anymore. It's here. So think about it, if entry price here, and if you recognize that this is the resistance, so this becomes your entry price. And your exit is somewhere here, which is kind of very tight situation. So resistance here. And then your stop loss. So you when it's pulling back, maybe you will not sell. You will not sell on this. You will wait for your, it's still making money, and then it will come some break even, and then it will lose, and then it will become a complete loser. So the further away the stock is, so you don't sell willy-nilly. That's one thing. You have to have some kind of a balance. If you ring the register quick, you will go broke also. So if you just ring the register for 15% gain in option, 15%, oh, I take my profit when I see 15%. So in order for you to take 15% gain, if you lose in one, 100%, the 7 winners have to compensate for one loser. So have to have some balance. So this is the story of stage one. Now I explained to you about the market type. So I'm aware of the bull market and the bear market definition, but I'm looking for uptrending market, downtrending market, and the sideways. So that's the way I define the market. So so there has to be some definition of uptrending. So higher highs, higher lows, or consecutive moves week by week. So I have my definition, and then so that's uptrending, and reverse it to downtrending. And then the market goes in a sideway when the market is not making a new high for several days. It just stays within the range, then it goes into the sideway. So 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 now look at this. Uptrending market, one category. Downtrending market, second category. And then the sideway market is the third category. If you divide the market, there are three categories. They are the same whether it's a bull market or a bear market. So even in a bull market, there could be market is down, uptrending. And even in a bear market, the market goes in an uptrend. That's where from bear it goes to bull. It just doesn't switch overnight from bear to bull. It doesn't happen like that. It doesn't go bear, bull, bull, bear. It's not a binary. It goes through different stages. So instead of defining bull and bear, and you wait for 20% definition or 10% correction definition, you must have a way of uptrending and downtrending and sideways. Now, so, so this is the definition. So you figure it out whether it's uptrending, downtrending, sideways. Now, there's something I have called volatility. So we all understand volatility. So, so I define the volatility into four categories, where the one is not mentioned here, which is very volatile. And the reason it's not mentioned very volatile because it doesn't, the very volatile market doesn't occur in uptrending or sideways. It only occurs in a downtrending market. So think of COVID days. That was very volatile market when Donald Trump was coming on the TV, everything is fine, there's no COVID, and the market was just tanking. Very volatile. And then it goes up. So remember those days, January, February? So that was a very volatile. That's the definition of volatile market. And the definition of uptrending quiet market is right now and when Donald Trump won the election. So the same kind of a market is happening, but I don't know how long it will last. So uptrending quiet. So the definition of uptrending quiet is the market moves up and up and up, and the volatility subside. So when the volatility subside and the market is moving up and up, there is a fortune to be made if you have the strategy of not catching, uh, not catching at the top. So have a trend trading strategies along with the support and resistance. If you are a short term or if you're a long term, then you just keep buying it. So volatility subside and the market is continuously in uptrending. This is where the fortune is made in uptrending quiet market. So this is what's happening right now. This is what happened back when Donald Trump won the election. Now the quiet. Now below quiet is a normal volatility. So if you measure the volatility based on normal parameters, it's normal. So before quiet, the market was normal when during first week of November. I will show you the table. I'll show you the table. And the uptrending volatile market doesn't happen much. So when the market is uptrending, it is not volatile. It is either quietly moving up or it's just in a normal fashion it's moving up. The downtrending market does not go down in a quiet manner. So it's opposite. The downtrending market doesn't go down in quiet manner. It doesn't go down in a normal manner. It goes down in a volatile and very volatile manner. So when the market is going down in a volatile and a very volatile manner, the traders need to be on their toes. So because one day they see the up market, second day they see the down market, and then they see the up market. They can see the triple digit gains in their puts, and they see it, the volatility increases, the premium goes up, and then it subsides, and then they say, oh, what happened? I'm not making, why I'm not seeing my gain even though the market is down. So the downtrending market is volatile or very volatile, not quiet or normal. The downtrending market have a shorter duration. Uptrending market have a longer duration. So the downtrending have a shorter duration. The uptrending have a longer duration. Uptrending market stays in a quiet, normal manner, not volatile. The downtrending market is not quiet, is a volatile and very volatile. The sideway market could be quiet, normal. Sometimes it turns into volatile also. So depending on so ask yourself, what kind of a trader are you? So what are you trying to achieve? If what is your age? And what else is going on in what kind of a portfolio you have? What is your risk profile? So if you don't ask these questions to yourself, and then you're trading all this kind of a market, and you don't even know what kind of market, so you just uh, not doing favor to yourself. So having to know this, and then match it with you, and then when it matches your style, that's where you say, okay, I want to invest in that market. So keeping that in mind, I created this slide as a Venn diagram. So if this is you are the one unique person in the world. That's the way God has created. So there's nobody like you, and there was nobody like you, and there will never be anyone like you. So me is me. There will nobody like me. Nobody came, nobody will come. I'm the only one. So if you are the only person, and there are so many kinds of market. You see, I showed you 9 types of market. So if we put very volatile factor also, then they become 12 types of market. So 12 types of market, and then you take a broader definition of a bull market and the bear market. So bull market and bear market, but at least uptrending, downtrending, and sideways, there are 12 types of market if you take very volatile into consideration. So there are 12 types of market at any given moment, 12 types of market. And the millions and billions of you, so 12 types of market and millions and billions of you, or is one you. So one you, 12 markets. So out of that 12 market, and it's you right here, say, let's say this is me, Noshi, and there are 12 markets here. So which market fit me? That's where this is the market I need to trade. So the intersection of the market and me, my personality, my risk profile, what I'm trying to achieve, what is going on in So when you take this intersection, that's where, and then you recognize it, that that intersection has happened, that's where the fortune is made. So, and then there are other components to this risk management, the trading system, the trading strategies, the trading symbols. So that's another topic sometime. Now, I'm showing you this table, which is based on um, my software. So I have my own software for market analysis, and I run this 5 times a week on major indices like Nasdaq, Russell, Dow Jones, S&P. So I run it, feed the data, and come up. So once the data is fed, the I get the results. So I explain to you how I take advantage and how you should take advantage. And for you, it's 97 for the whole year. So if you see if you are serious, if you have any, I don't know, any desire to make money in the market, subscribe to this. My newsletter for market is 97 for you for the whole year. In this service, I don't. This is not the trade alert service. Sometimes I send you the complimentary, but don't rely on this service to give you the complimentary, the regular trade alerts. I don't send that. This is just for to tell you on a daily basis what the market is doing. So here's the date column. So you see the analysis date. It says 25th of October, then 26, 27. So it's working backward, and I will explain to you. So before 1st of November, so you see this the minor trend. It says uptrend, and I put it in the green. So before the 1st of November, the overall condition of the market was, according to the definition, was in a downtrend. So the market was in downtrend. And the first signal came as a warning sign that something is happening on the upside was on 30th of October. So when I don't get the confirmation, of uptrend, but I get the reading on the market that something is happening, which is telling me the market is looking to move up. So I put the asterisk sign here to show you, or to show me also, that there's something going on in the market, and don't open any more new short position. Be aware of not to open the short position. And the market condition is strength. So not only the trend is analyzed, but you need to know the strength of that trend. If you don't know the strength of the trend, you're fooling yourself that if there is no strength in that trend will turn into choppy, and then it will give you false signals, false upside signal, false downside signal, and the result is just a disaster. So the trend strength need to be understood also. So the 30th of October, so think about this. Just think about it. So this tells you, this analysis is based on the reading of the dinosaurs. I call them dinosaurs. They can run, but they cannot hide their footprints. So I'm detecting their footprints. So the footprints telling them that they are coming in. The market strength is still showing weak. It was very weak, and it turned into weak, but it's still weak, right? So it's still weak. It was very weak, and it's weak, and the volatility was normal. But this was just a warning sign that something is happening, and the strength turned from very weak to weak. But it's not a signal for you to go long. And but if you're watching your basket of stock, you should see that something is happening. And usually, what happened in this kind of situation, the big Nasdaq stocks, the big. Yeah, so there was a time just 4 or 5 months ago where the Dow Jones stocks moved first. So one of the indices stocks, they move in harmony. Whether so usually it's either a Dow Jones or the Nasdaq. So either the Dow Jones or the Nasdaq, they come in, like they wake up. So when they wake up, so not only the stocks, few selected stocks are moving, but they belong to a certain indices. So either it's a Nasdaq or it's a Dow Jones. So you have to analyze that which market. So previous to that, when the uptrend signal came, it was Dow Jones. So I remember that. This time it was Nasdaq stocks. So So once I get the green signal, so warning sign, and then on 1st of November in the minor trend. So minor trend is still not a sustained trend. So minor trend because the bigger the cycle, so you're biasing you if the bigger trend is still on the other side, you are being cautious. So the bigger intermediate trend and the major trend was still in downtrend, but up, the minor trend turned uptrend. So now I'm on a high alert and I'm opening a long position on a selected stock because I see that uptrend and I'm looking for the strength from the neutral to turn into the green side. So I have a barometer. I select in a barometer format. I show you on the green side if the strength is strong. I start showing you on the barometer and I start putting my strength signals here. So I'm looking. So the time to pile up is this or build the position is when the strength turns into green and minor and intermediate trend both are on the uptrend side. So watch this first, second, third. So it's still not till 9th of November. I didn't get the signal, but then on 14th of November. So 14th of November is the ultimate signal I got for to go long. 14th of November. So what happened? Intermediate trend and the major trend both gave me upward signal, and the strength of the market turned into strong. So this was the ultimate buy signal. This is where uh, just imagine all the big boys, they have been buying from 1st of November all the way to 14th November. And since then, the market is moving up. There's no pullback. There's no weakness. And what happened, the volatility turned on 17th of November, the volatility turned from normal to quiet. So this is another buy signal here, the volatility turned to quiet. So when the market is in uptrend, which showed on the 14th of November, and the volatility turned quiet, this is the kind of market where a lot of money is made. If you are, if you know what you're doing, either you have a long-term position or you're trading options. If you're trading options, you're timing your entry and exiting it, timing your entry and exiting it, selected stocks. That's where the fortune is. So quiet and uptrend. So 28th of November, and then 29th of. So now on the only thing what is happening is nothing is changing here. The only thing changing is the strength of the market. So strength, as long as the strength stays on the strong and a very strong side, this is the market where the lot of money can be made in a very short period of time, like $200,000, $300,000, depending on a $500,000 portfolio, 1,200,000 per month. So right now, the 14th of December, as of 14th of December, the market strength is very strong. So now you see, the question is this: it's all good, but then you have to be on a suspicious and on a high alert. And why? Because I have seen most of the time the market makes a top, whether it's a short-term top or ultimate top, around some major event. So think about it, not only the price, volume, and strength and volatility you're watching, but you are also asking yourself what is the major event just now occurred or about to occur. So the major event occurred on 13th of December. So on 13th of December, FOMC, the interest rate, etc. But the market condition is saying uptrend, 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 confirm uptrend, right? So in order for the effect of FOMC in the coming days, the market. Uh, so my first signal would be the market will start losing its strength. So I would watch for the strength here, that it will turn from very strong to strong, and suddenly it will start going towards the mildly strong, and something will happen which will give me the signal on the minor trend. Just like I have this green asterisk to tell me that the market is in downtrend, but something is coming on the buy side. So that kind of a, when I detect that, then I put the red dot, and then the strength uh, will will go down from very strong to strong. But it doesn't mean I go on a cash. It's not like that. You don't just suddenly you panic and you say, okay, it's time to go cash. No, it's just that I'm on a high alert. And then look for those stocks So think about this. So if you're trading, look for those stocks which are um, doing the initial of stage four. Go into that sector. You don't have to trade all the time technology stock. Look for those sectors, those industry group where the money is rotating. Money is coming out from one and then moving in into that sector, which is in stage three and about to start stage four. And then even in a tech stock, so look at the Baba, Baidu, Oracle, all this kind, and then look at the oil stock. Maybe you find something else which is in a stage three and about to create a new stage four. So they will sell here and they would uh, create another stage four in another market, another indices, another sector. So that's the way the market is. So I wanted to let you know what's going on. So it corresponds with the 7 ages of Shakespeare. So it's their exits and entrances. They have their exits and their entrances. And all the men and women are merely players. So just like 7 ages of man described by Shakespeare, so I try to describe the market in 7 stages. So if you have any questions, please send email to my team, success@tradegenie.com, and they will help you out. I strongly suggest you subscribe to this report. It's for you because you attended, is 97. Send email. And if you have other source market, let me know. If you are happy with that, let me know what else is going on. Um, I'm always trying to learn. So maybe I'm missing out something. So if I'm missing out, if you find somewhere and you say, Noji, you're talking late. 1st of November, it was too late. I got from this service or my own analysis, I got the signal way back that the market is. So please let me know. Okay. Did you get the buy alert on 1st of November and confirm? So your trading um, depends on by looking at, so I send you the report early morning. So, and then intraday update. So I would start sending you intraday update. If there is a major change, then you will get the intraday update that something is happening. So I will incorporate. So you can increase your exposure and or decrease your exposure, knowing the strength of the market is so important. I mean, I don't know how early morning when I analyze it, and I see the market strength is strong, and some position are pulling back, knowing the market strength is strong, I stay in the market. I put more money into because I know that this pullback is just temporary because I'm reading the overall market, not just individual stock and saying, okay, it pulled back $1, I need to exit. No, don't exit just like that. The overall market is bullish. So from the get-go, I have a reading on the market all day long, every day, 5 days a week, 7 days a week. I know about the market. This is what you need to have. 80% of your success lies on understanding the market. The rest is easy. Especially it's easy when you are trading uptrending market in a quiet volatility. I don't know how long it will last, but just keep an eye on QQQ for NASDAQ and other indices. Also very overbought. Yes, I watched IWM. So all these four, Russell, Nasdaq, Dow Jones, and S&P. So one of them become a leader, and another one become a laggard. So this is what happened. The Nasdaq was the leader, and the Russell was the laggard. So now Russell is also moving up, but the Nasdaq is a leader. So whoever is the leader when they start the rally, that is the first one to reach the top, right? And the last one is the last one. It's like we have a word back home called Fisaddi. The Fisaddi means the guy who's limping and coming, three guys are way up there. One is, let's say one is reached the summit. The second guy is a base camp 4. The third guy is base camp 3. And the last one is still in base. He's just sitting there, or he's in base 1. And the other guys are just retreating and saying, hey, okay, it's time to go home. And then, no, 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 I want to go up. Wait for me. I want to go up. I have not reached the summit. But they say, no, 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 no. It's done. So the last guy, he just retreat and then just give up and then come down. So usually it's a small cap. They just clobbered. Everything is coming down because the leader has reached the summit. It doesn't matter. So they all bring down. Sometimes the ultimate is when all four reach in harmony somewhere, reach the same destination somewhere. That's the ultimate top. That's where the ultimate top happen, when all four reaches some major target at the same time, like a little bit of gap. So that's like everybody reached the summit, and now it's time to go home. So that's the ultimate top. All right, I'll see you maybe next week or maybe Monday, Tuesday. Thank you. Bye.